Welcome to our podcast about the fascinating world of private equity, where our focus today will be on the three main types of investment firms: private equity, hedge funds, and venture capital. Each of these investment firms operates in its unique way, and it's essential to understand their differences to make informed investment decisions. Private equity firms, hedge funds, and venture capital share many similarities, but they also have fundamental differences. Let's begin with private equity firms. Private equity firms invest in privately held companies, which are not publicly traded, and make their money by acquiring companies or stakes in companies and then selling these later on. Private equity firms often work with large amounts of capital, buying and selling companies in a range of industries, offering guidance, and helping companies to improve their performance. Moreover, private equity firms are typically long-term investors, as they take an active role in the management and operations of the companies they invest in, utilizing their expertise to help the company optimize its operational and financial performance. On the other hand, hedge funds and venture capital investors also have different investment strategies. Hedge funds are a type of alternative investment that typically uses a variety of investment strategies to generate high returns for its investors. To put it simply, hedge funds are actively managed portfolios that rely on complex trading strategies such as short selling and leverage. Unlike private equity firms, hedge funds don't take a long-term investment approach, holding their investments for shorter periods, often just a few days or weeks, before selling them off for a profit. Venture capital firms typically invest in early-stage businesses or startups with high potential for growth, offering financial support and business advice in exchange for a stake in the company. Venture capital investors are known for their high-risk appetite, as early-stage companies often have no proven track record or revenue to show when they're seeking funding. Venture capital firms use a hands-off approach, allowing the startup's founders to manage the company and make decisions independently while providing guidance and resources to ensure they stay on the path to success. In conclusion, while each of these investment firms operates differently, they all have the same goal: to generate high returns for their investors. The key difference between private equity firms, hedge funds, and venture capital investors lies in their investment strategies, target companies, and investment horizons. Private equity firms focus on long-term investments in established companies, while hedge funds use short-term trading strategies to generate profits, and venture capital firms invest in startups that have the potential for long-term growth. We hope that you have found this podcast informative and that it provides you with a greater understanding of the differences between private equity, hedge funds, and venture capital investors. As always, if you have any questions or comments, please feel free to reach out to us on our website or social media channels. Thank you for listening.